Your money invested can grow bigger than you can imagine. And that is because of compound interest. Compound interest is the most powerful concept in building wealth. And even Albert Einstein said, compound interest is the eighth world wonder. He who understands it earns it. He who doesn't pays it. That is why in this video we're going to take a closer look at it. We'll start with what compound interest is, how it is calculated, and which of the components are the most relevant for us as personal investors. I will show you where I specifically try to implement compound interest in my investment strategy. Then I will introduce you to the rule of 72. And in the end we will go through some common mistakes that people make when it comes to compound interest. Let's start with what compound interest is. Let's say you put in an initial amount of money, and then initially you earn interest on that amount of money, and after that you also earn interest on the amount of interest from the first time. So it's basically an interest on interest. That means in each period of time your principal becomes larger, and the longer this goes, the more accelerated the growth is. Let's take a look at the simple interest in comparison. So with the simple interest you also put in an initial amount of money, and then you earn interest on that amount, but because either you take the interest out or the interest is only ever paid for the initial amount of money, the interest remains the same every year, and therefore the growth of the interest is linear. But with compound interest, the interest is calculated on the principal amount plus the previously earned interest. So that means the principal changes every year, and therefore the compound interest doesn't grow linear, but it grows exponential. Let's take a look at the compound interest formula. So the formula of compound interest looks like this. And please don't be overwhelmed. I have never used it to calculate anything. If I want to know a number that's connected to compound interest, I just use a website with a compound interest calculator like investor.gov. But for this video, I wanted to demonstrate the different components that goes into compound interest so that we can better understand it and use it for ourselves. Alright, so we have the principal, and the principal is what you put in. And that can be once, or it can also be every month. Then you have the interest rate in percent, which is the annual interest rate that you earn on your principal. When you choose a well-diversified index fund like I do, the interest rate will be around 6% per year. Then we have the compound frequency, and that is the number of times per year that the interest is compounded. So if it only compounds once per year, that is a 1. Maybe it compounds every quarter, then this is a 4. And the more frequently the interest is compounded, the faster your money grows. And lastly, we have time, and time is the number of years you let all of this compound. Now, to make this a little more vivid, I will use an example here that blew my mind when I first heard it. I heard it from a German investor, but it originally goes back to Richard Price, who was an 18th century philosopher, and it goes like this. If Joseph would have put 1 cent in a bank in year 0, and that at an interest rate of 5%, and he would have let the interest compound over time, then after 2,000 years he would have accumulated 23.9 duodecillion dollars. That is a number with 39 zeros, and it is equivalent to 118 billion Earth globes out of pure gold. Now, if Joseph would have taken the interest out each year and gave it to Jesus, he would have earned a simple interest instead of a compound interest. Then after 2,000 years, he would have $1. That is the power of compound interest. If you found that example as impressive as I did, I would love if you could leave a like. Thank you. Of course, none of us will live that long, but I think this example shows very nicely how hard it actually is to fathom exponential growth, and also its crucial role of time. That's why it's so important to start early. Now let's look at a more realistic example. Let's say we have two people. The first one is Jane. Jane starts investing $100 per month, and she starts at age 20. And let's assume an interest rate of 6% per year, and she had no initial investment. At age 55, so after 35 years, she will have accumulated $133,721.74. Now on the other hand, let's look at Tamara. Let's say she also starts investing $100 per month, but she doesn't start at age 20. She starts at age 30, so 10 years later. She also has no initial investment, and let's also assume an interest rate of 6%. At age 55, so 25 years later, she will have accumulated $65,837.41. That is less than half the amount of Jane, just because she started 10 years later. So when it comes to compound interest, time really is money. But there is also another component that I would like to emphasize here, and and that is the principal. Let's say Tamara went to university and she wasn't able to put aside the $100 per month. So she starts later, but because then she has a higher paying job, she doesn't put just $100 each month in it, but $200. So she doubles the amount every month. Then in the same time horizon, she will have accumulated $131,674.83. So that would mean she almost reached the same level as Jane. So you can beat time by amount invested, but this will depend on your goals and also how much you can put aside to invest. Of course, the best combination of both is to have a long time horizon and a high amount. Whatever high means here, so just as much as possible. With that, you can get very rich. Now let me share a real-life example where I try to implement the compound interest. So my investment strategy is to invest the biggest part of it into well-diversified index funds. And when I pick an ETF, I can usually choose between distributing and accumulating. Distributing is when all the dividends that get paid by the companies within the ETF get paid. And accumulating means that the dividends that get paid from the companies within the ETF, they get reinvested into the ETF immediately. So when I can choose, I will always choose the accumulating ETF, because by reinvesting the dividends, I earn interest on interest. And I don't even have to actively do anything. An accumulating ETF does that all by itself. And of course, I also keep investing monthly or quarterly or half yearly or whatever suits best at the time. And then my principal also grows, but it kind of grows linear, or whatever amount I'm able to put in. But by choosing the accumulating version, I additionally let it grow exponentially. And the third component in all of this is that not just the dividends get reinvested and earn interest, but also the companies within the ETF grow in value over time, hopefully. Now let me introduce you to the rule of 72. That is a quick estimation to find out how long your money takes to double with compound interest. You take the number 72, that's why it's called the rule of 72, and then you take your estimated interest rate, and then you divide the interest rate from the 72. And then it'll give you the number of years that it will take to double your money. Now, for example, let's take the 6% interest rate of an index fund. So 72 divided by 6 is 12. So that means it'll take you around 12 years to double your money. Now let's take a look at the common mistakes that people make when it comes to compound interest, and that keeps them from maximizing its power. So one mistake is not starting early, and that comes down to the component of time. People procrastinate on investing for so long because they think they have time, and they don't realize how much money they actually leave on the table by this. The second one is not investing enough. This refers to the principal. If we only ever invest small amounts of money and we don't correct that number over time when we earn more, there is only so much that we can expect. And of course, at some point, our time is always limited by death. We have maybe 30 or 40 or 50 years, and then the remaining lever is just the principal, so the amount of money invested. Another mistake that relates to is to not take advantage of tax-advantaged accounts, because taxes are a type of costs, and costs will diminish the return because they reduce the principal. And that same applies to other kinds of costs. People often underestimate the impact that costs have. They also reduce the principal, and therefore they also reduce the returns. Another pitfall is to not consider inflation. So when you want to check out that compound interest calculator, put it in the video description, and it'll spit out a huge number, and you're going to be like, oh wow, that's so much. Always keep in mind that 10 or 20 or 30 or 40 years later, you will not be able to buy the same things from this money than you are now. So you should never calculate on the dime. Also, a mistake is to interrupt the compounding by taking the money out. That's why I'm so eager to say always start with the emergency fund so that you have money on the side when you need it. And for those of you who have already some experience with investing, ignoring your risk tolerance can also be a pitfall. So we talked about the equation of compound interest, and one component is the interest rate. Now, to maximize the compounding, you might be tempted to choose the highest interest rates you can find, but that will mean to choose risky investments. But if you don't align your investment strategy with how much risk you can actually handle and tolerate, you run the risk of selling everything in an emotional state, and then you will also have interrupted compounding. Maybe you have even lost. And by the way, the power of compounding can be very powerful when we use it to earn money, but it can be equally negative when we are in debt, because debt also compounds, but it compounds against you. So you should always have an eye out for that. When after hearing all this, you are eager now to start investing yourself and you haven't yet, you will find a video on how to pick a simple investment strategy here, and another one where I go through all the different criteria that I look at when choosing an ETF, I hope you got some value out of this. Thank you for watching, and I hopefully see you in the next video. Bye bye.